Interest rates and inflation are two closely linked economic factors that significantly impact consumers. As inflation rates rise, central banks often respond by increasing interest rates to curb spending and bring inflation under control. However, this can create a challenging environment for consumers who face higher borrowing costs and reduced purchasing power. This video explores how rising interest rates, driven by inflation, continue to squeeze consumers, impacting everything from mortgage payments to everyday expenses. The relationship between interest rates and inflation. Interest rates and inflation are intrinsically linked through their impact on the economy. Inflation refers to the rise in the general price level of goods and services over time, which erodes the purchasing power of money. Central banks, such as the Federal Reserve in the United States, use interest rates as a primary tool to control inflation. When inflation rises, central banks typically increase interest rates to make borrowing more expensive. This, in turn, reduces consumer spending and business investment, which helps to cool down the economy and curb inflationary pressures. Conversely, when inflation is low and economic growth slows, central banks may lower interest rates to stimulate borrowing and spending. Lower interest rates reduce the cost of loans for consumers and businesses, encouraging investment in homes, cars, and capital projects. This increased spending and investment can boost economic activity and help lift inflation towards a target rate, ensuring price stability and supporting economic growth. The aim is to maintain a balanced economic environment, where inflation is kept at manageable levels, typically around 2% annually for many developed economies. However, this balancing act is delicate and can be influenced by various external factors, such as global economic conditions, supply chain disruptions, and fiscal policies. Central banks must carefully monitor economic indicators and adjust interest rates accordingly to maintain a stable economic environment. The interplay between interest rates and inflation is a dynamic and ongoing process, requiring constant vigilance and adjustment to achieve the desired economic outcomes. Impact on mortgages and housing costs. One of the most immediate and significant effects of rising interest rates is on mortgage payments. As interest rates increase, the cost of borrowing for home purchases goes up, leading to higher monthly mortgage payments for new homebuyers. This can particularly affect those with variable rate mortgages, whose payments can rise significantly as rates climb. Even homeowners with fixed-rate mortgages might feel the impact if they plan to refinance or move to a new home, as they would face higher interest rates than before. The increase in mortgage rates can also dampen the housing market by reducing affordability for potential buyers. When interest rates rise, the amount of money that buyers can borrow decreases, which can lead to lower demand for homes. As demand falls, home prices may stabilize or even decline, which can impact homeowners' equity and the overall real estate market. For sellers, this can mean longer times on the market and potentially lower sale prices, making it a challenging environment for anyone looking to sell their property. Higher interest rates not only affect individual homebuyers, but also influence the broader economy. A slowdown in the housing market can have ripple effects on related industries, such as construction, home improvement, and real estate services. Reduced activity in these sectors can lead to job losses and decreased economic growth. Additionally, with fewer people buying homes, there might be an increased demand for rental properties, which can drive up rental prices, adding further financial strain on consumers. The overall impact of rising interest rates on mortgages and housing costs underscores the interconnected nature of the economy and the far-reaching effects of monetary policy decisions. Credit card debt and personal loans. Rising interest rates have a pronounced effect on credit card debt, making it more expensive for consumers to carry balances. Most credit cards have variable interest rates tied to the prime rate, which is influenced by central bank policies. When interest rates increase, credit card interest rates also rise, leading to higher monthly payments for those carrying balances. This can quickly add up, especially for consumers already struggling with high levels of debt, making it harder to pay off balances and potentially leading to a cycle of increasing debt and financial stress. Personal loans are also impacted by rising interest rates. These loans, often used for significant expenses like home improvements, medical bills, or debt consolidation, become more costly as interest rates climb. Higher interest rates mean higher monthly payments and increased overall costs over the life of the loan. For consumers considering taking out a personal loan, the increased cost might deter them, leading to postponed or abandoned plans for major purchases or debt consolidation efforts. This can affect their financial planning and overall economic behavior. The broader economic impact of higher interest rates on credit card debt and personal loans extends beyond individual consumers. As borrowing costs rise, consumer spending tends to decrease, which can slow down economic growth. Reduced spending affects businesses, leading to lower revenues and potentially slower job growth or even layoffs. Additionally, financial institutions may see an increase in loan delinquencies and defaults as consumers struggle to keep up with higher payments, which can impact the stability of the financial sector. Overall, the interplay between rising interest rates, consumer debt, and economic activity highlights the complex and far-reaching consequences of monetary policy decisions. Impact on savings and investments. While rising interest rates can be challenging for borrowers, they can benefit savers and investors. Higher interest rates often lead to better returns on savings accounts, certificates of deposit, CDs, and other fixed income investments. This can encourage more saving and provide a safer investment option for risk-averse consumers. However, the impact on the stock market can be mixed. Higher interest rates can lead to lower stock prices as borrowing costs for companies increase, potentially reducing profits. Additionally, higher returns on fixed income investments may attract investors away from stocks, leading to market volatility. Inflation and everyday expenses. Even as interest rates rise to combat inflation, consumers continue to face higher prices for everyday goods and services. Food, gasoline, utilities, and healthcare costs often increase during inflationary periods, squeezing household budgets. Higher interest rates may eventually help to curb these price increases, but the immediate impact can be challenging for consumers. Inflation erodes purchasing power, meaning that the same amount of money buys fewer goods and services over time. This can lead to difficult choices for families, such as cutting back on discretionary spending, seeking cheaper alternatives, or dipping into savings. Impact on business and employment. Rising interest rates also affect businesses, which in turn impacts employment and wages. Higher borrowing costs can lead to reduced capital investment, slower expansion plans, and hiring freezes. Small businesses, which often rely on loans for growth and operations, may be particularly hard hit. As businesses adjust to higher costs, they may pass on some of these expenses to consumers through higher prices. Additionally, if businesses slow hiring or lay off workers, it can lead to increased unemployment and reduced consumer confidence, further slowing economic growth. Policy responses and consumer strategies. Governments and central banks closely monitor the interplay between interest rates and inflation, making policy adjustments as needed. For consumers, understanding these dynamics can help in planning and managing personal finances. Refinance loans early. Consumers with variable rate debt should consider refinancing to fixed rate loans before interest rates rise further. Locking in a fixed rate can provide stability and predictability in monthly payments. Increase savings. Higher interest rates can benefit savers. Increasing contributions to savings accounts or investing in CDs can take advantage of better returns. Budget adjustments. With rising costs, reviewing and adjusting household budgets becomes essential. Prioritizing essential expenses and cutting back on non-essential spending can help manage the squeeze on finances. Invest wisely. Diversifying investments can help manage risks associated with higher interest rates and inflation. Balancing between stocks, bonds, and other assets can provide more stable returns. Stay informed. Keeping abreast of economic indicators and central bank policies can help consumers anticipate changes and make proactive financial decisions. If you found this video helpful, please like and subscribe to our channel for more insightful content on managing your finances in a changing economic landscape. Stay tuned for more tips, news, and expert advice to help you navigate your financial journey with confidence. Don't forget to hit the notification bell so you never miss an update. Thank you for your support.